Good evening, everyone. Thank you so much for joining us this afternoon for the webinar Real Estate Investing 201. Today's webinar is hosted by the Marilyn Smith Young Alumni Council and the Robert H. Smith School of Business, Office of Alumni Relations. My name is Caitlin Deitch. I am a 2014 graduate of the Robert H. Smith School of Business and currently a member of the Marilyn Smith Young Alumni Council. If you can just please note that this webinar is being recorded. Everything's going to be captioned. The audio line is going to be muted for everyone. And if you do have any questions, we encourage you to use the chat feature to enter any questions or comments you may have for the presenters. So with that, I would like to introduce our moderator for the evening. Terry Jarbo Ferry is a CPA and MBA. She is the president and CEO of Buyers Title Inc. Terry began her career in public accounting in the audit and tax departments. She later became the manager of a title company where she worked for several years before starting Buyers Title Inc. She specializes in residential and commercial real estate transactions, and she was previously named Entrepreneur of the Year by the Charles County Chamber of Commerce. And in 2019, she was named one of the Poet and Quant's Online MBA's Best and Brightest. Please welcome Terry, who will introduce all of our featured speakers for the evening.
Hi, can you hear me? Okay. Thank you, Caitlin, for the introduction. As Caitlin mentioned, my specialization is in residential and commercial real estate transactions. So I'm looking forward to guiding us through this evening's discussion and also learning from our speakers and their expertise. With that, let's meet our speakers. Our first is Akeem Awad. He is the founder of Financial Freedom Investments. Akeem is from Baltimore, Maryland, and graduated from the Robert H. Smith School of Business at the University of Maryland, College Park. Over the last 8 years, he has invested primarily in real estate, and as part of a diversified investment strategy, he invests in stocks as well. He mentors other investors and teaches them how to invest by sharing his knowledge and lessons learned over the years. He strongly believes in mentorship and giving back to the community, and he aims to fill that role as he continues to accumulate real estate. Most recently, he has purchased 7 properties in the last 12 months, flipping some and renovating others into affordable and rental properties. Please welcome Akeem Awad. Our second panelist is Scott Johnson. He is the Director of Investments for Fundrise, a technology company with a mission to build a better financial system by empowering the individual and democratizing the world of private real estate investing. He is responsible for managing their investor relations team and working with teams across the organization to ensure Fundrise has the resources to properly service investors and educate prospective investors. Before joining Fundrise in 2019, Scott spent over 6 years at Cambridge Associates, an investment management firm managing teams of people. Scott graduated from the University of Virginia with degrees in economics, psychology, and a minor in astronomy. In his free time, he enjoys cooking, spending time with his family, and playing and watching sports. Please welcome Scott Johnson. Our third panelist, Eugene Perverni. His expertise encompasses structuring and managing the development life cycle from project feasibility studies to site control, financing, syndication, construction management, asset stabilization, and disposition. Mr. Perverni founded the firm Perverni Sheet Group in 2011 and continues to be the driving force behind its growth, and is thankful for the talented people that work at PSG to help make its projects and business lines a success day in and day out. Mr. Perverni holds a JD from the George Washington University and an MBA from the University of Maryland. Please welcome Eugene Perverni. So let's give a warm virtual welcome to all of our speakers at this time. Gentlemen, thank you all for being here this evening. We have a short amount of time together this evening, so we're going to go ahead and get started. First, wanted to start with a little bit of background about what is real estate. So real estate is a class of real property that includes land and anything permanently attached to it, whether it's natural, such as a stream, or it's man-made, such as a house. There are 5 main categories of real estate: residential, commercial, industrial, raw land, and special use, which is like mining. But tonight, we're probably going to talk mostly about residential and commercial. And there are several ways in which you can invest in real estate. It can be directly by purchasing a home, a rental property, or other property, or it can be indirectly through a real estate investment trust. So a real estate investment trust are basically dividend paying stocks. So today we are going to talk and answer some questions about how to invest in real estate. The primary ways in which investors make money in real estate is first the appreciation of value. So you buy low, you sell high, that is appreciation. Becoming a landlord of a rental property could be a long-term rental, it could be Airbnb, and profit from business activity. So an example would be if you're buying and you're operating a bakery. We're also going to discuss property flipping. So those are the people buying undervalued real estate, fixing them up and selling it. So we see that on HGTV all the time. Everybody wants to do that. Real estate investment groups, they're more of a hands-off way to make money in real estate. Real estate owners can buy a property using leverage. They can pay a portion of its total cost up front and then pay off the balances over time. So now that we've gone over a little bit about real estate, we're going to turn to our panel for some additional details about real estate. So prior to today, some questions have been submitted. So we're going to turn to our panel and have them answer some of these questions. So Akeem, I'm going to pose this first question to you, starting out with how should a new investor choose the location, the market to invest in, and then kind of assess its growth potential?
All right. So one of the things you want to consider when you're looking into getting into real estate investing is what kind of market is going on right now. Is it a buyer's market or is it a seller's market? As a lot of people know, with the pandemic over the past year, the market has kind of turned to a seller's market. So prices are super high. And so when you have that kind of information, that could help you determine where you're going to or where you want to invest. For example, it could sometimes price you out of certain markets. So DC, for example, is an already expensive market to invest in. And then now with it being a seller's market, if you're just getting into real estate investing, you may have to kind of go down the Beltway and consider Baltimore, whereas before, you were looking at Washington, DC, for example. So that's one of the things that you can kind of look at to try to figure out, all right, what is the market right now? And, how do I want to go about picking a market? Another way you can kind of decide that is just based on location. A lot of times they recommend, experts recommend that you invest somewhere that is local to you. So within like 30 minutes. So that way you can kind of check up on the property, you're familiar with the area. There are a few other reasons why, but that's just one piece of advice that a lot of times is, thrown out there for people. And yeah, so that's how you would consider or determine where you want to invest.
So are there any formulas that you would recommend to determine like the return on investment that we could use to weigh like one place versus another?
Yes. So there are a few different formulas and a few different rules out there. One of the most common rules for rental properties, and it's going to depend on what your strategy is and where you're trying to invest. But when it comes to rental properties, you have the 1% rule. You also have the 2% rule, and they're very closely related. And that just kind of helps you to figure out, what is the rent in this area, and then how much, based on that rental price that I could get for renting this property out, how much is the most that I should pay for this property. And an example of that would be for the 1% rule. If you're looking at a property in an area that rents out for about $1,000 a month, then the 1% rule would tell you that the most you want to pay for that property is $100,000, right? And if you're applying the 2% rule, then the most you would want to pay for a property is $50,000. So that's one rule that a lot of people use for evaluating rental properties. When it comes to evaluating fix and flips or rehabs, they have something called the 70% rule. And that is basically where you want your all-in costs for your purchase price and your rehab to be 70% of the ARV, and ARV is the after repair value of the property. So essentially that is what properties are selling for in that area. Once they're all fixed up, once they're all, done, looking pretty, whatever they're selling for, you would want to keep all of your costs to 70%. And that's for more so rehabbers or flippers. And you want to use that because that extra 30%, some of that's going to go to paying, taxes and paying the realtors and all that. But basically most of that is going to be your profit. And so you kind of want to stick to that rule to make sure that you walk away with a profit once it's all done. And then one additional rule that some of the other panelists will be able to speak on is just when it comes to cap rate. Multifamily isn't my specialty, at least not yet. And I'm looking forward to going into that in the future. But cap rate is very big when you're evaluating multifamily or commercial properties. So that's something that hopefully someone else will be able to kind of speak on a little bit later. But those are just some of the high level rules that you want to keep in mind.
Great. Thank you, Akeem. Does anybody else on the panel want to contribute anything to those questions? Okay. So I'm going to go to Eugene. Are there any types of properties that you would recommend for a first-time investor? So for example, a beach house rental versus a townhome in a neighborhood close by, that kind of thing?
Sure. No, thanks for asking, Terry. And look, just by way of background, Terry, I appreciate the introduction. So, Eugene Pavarni, PSG, we're about 30 people based out of Baltimore, Maryland, focused on these days mainly multi-family development and self-storage development. And we also lend money, private credit, provide fix and flip loans, provide ground up construction loans up and down the East Coast. I say that just for context. I think it's important that, as we're kind of giving feedback, people also appreciate kind of what the background is of the speaker. Today we own about 1 million feet of storage, maybe another 500 apartments. And we've done about 150 loans where we've lent out money in the last 5 years, maybe up 250 million of real estate or so. And I say that to really answer your question, Terry, which is, what do we start with? And the first building that I ever purchased, which was in December of 2009, was a 3-unit multifamily building that somebody else had started renovating and kind of fell apart on during the last housing crisis for $40,000 in Baltimore, Maryland, that we went in and improved. So whenever I get this kind of question, whether it's from friends or from family, like what's a good entry point? Like what's a good entry point into the market? What do you do? I'm a big fan of the 1 to 4 multifamily space. I'm a big fan of it because the problem that most people have, including us when we were getting started, which is, where do you get the capital from in order to buy your first building or do your first real estate deal or whatever it is. And the US government has been very kind to the 1 to 4 family space and provides really good high leverage financing options there, where, you can live in 1 unit and rent the other 2 or rent the other 3 and effectively get 95, 97% of what you want to spend on these small apartment buildings in the form of very cheap financing. I'm a huge fan of that as an entry point to the market. I think you get to tap really cheap debt. You get to borrow money, whether it's FHA or through other government programs at very high leverage points at very low cost of capital, right? Something that as you do more of these projects, as you go on, as you try to, whether you're going to be flipping more or whether you want to accumulate a portfolio, you realize how amazing it is to be able to borrow 95% of the money you want for a transaction at 4%. Really is. So I'm a big fan of that as an entry point. Small, easy to finance, relatively straightforward to execute. Don't go too fast, too quickly.
So you mentioned that multifamily. So what are your feelings on like a weekly vacation rental versus a monthly rental, or I guess the apartments would be year to year?
Sure. Look, I think it's a question of how much brain damage are you willing to live with, right? The most volatile and the most profitable asset class, let's go back 12 months before COVID, were hotels, daily rentals, right? I rent you something every single day. And if I can keep it occupied, if I can keep that hotel room filled every single day, I'll make a lot more money renting you a room than I ever will renting you, something for a week or for a month or for a year. With that duration, those longer term leases come discounting. So it's a brain damage question, right? If you're willing to rent things on Airbnb for 4 days or 5 days at a time and have 5 tenants go in there a month and get the cleaning service that comes with it and the headaches that come with the customer service, you can get more quote unquote profit if you want to deal with more brain damage.
Gotcha. So thank you for explaining that. We know starting out, it's not going to be easy for anyone that's just getting into real estate investing. So we're going to talk a little bit about that. I'm going to direct this question, actually, Scott, Eugene, or Akeem, whichever would like to answer first, about what are some of the barriers for entry into real estate investing. So, for instance, setting up an LLC or putting the property in your own name, securing an attorney, capital, things like that. Would one of you like to start with some barriers you may have faced or that you know are going to face, anyone will face getting into investing?
Sure, I'm happy to start. And similar to Eugene, again, thank you so much, Terry, for the introduction, but just a little bit more color to my background. So the company that I work for, we manage a number of non-publicly traded REITs for about 150,000 and growing investors. We currently have about 1.5 billion under management, and we've invested in about 240 currently assets across the country, mostly in the residential space, but it is a diversified portfolio. So to your question about some of the barriers, I think three come to mind to me immediately. I think the first one Eugene touched on just a minute ago is capital. I mean, even though you can get loans for real estate and apply leverage, having money for a down payment still is something that not everyone has access to. So I think that's the first thing that comes to mind. And beyond just a down payment, especially if you're doing renovations, needing a budget for that. And again, even if you're not planning to do renovations, things can go wrong if you're trying to buy a rental property that you need to fix things that you didn't necessarily expect. So having a budget for that. I think the second thing that comes to mind is expertise. There's so many aspects of real estate investing, whether that's needing a realtor, needing an attorney, sometimes needing a tax accountant for all the tax benefits that come with potentially owning real estate. So the expertise is another one. The last one is the time. Real estate investing can be a very, very time intensive aspect, especially if you wanted to be a landlord or even operate an Airbnb. Those are three, I think, really big ones that come to mind that at times push people away from maybe the more active management of real estate and investing in real estate in potentially more of a passive fashion, whether that's through a fund or REIT ETF or something along those lines.
Great, thank you, Scott. How about Akeem, would you like to contribute to that on some barriers?
Yes. So definitely picking up on what Scott said about the expertise. So that's what I try to help kind of solve or be an option for other investors as they're beginning. Like I said, I mentor people as they're getting into investing. And I think having someone who's kind of, been down that path, been down that road is beyond helpful and beyond crucial. And just because of not just because of the knowledge that they have, but also because of the connections and the mistakes that they've made, and they can, literally just save you time on certain things. So I think expertise as far as like maybe the trades or whatever you need, as far as work done or, realtor or lawyer, but then also just someone who's actually been down the exact path that you're trying to go down. So mentorship has always just been very high on my list. And so that's one of the things I look to accomplish or be an option for people as they get into investing. And then another barrier of entry that I hear a lot of times is, do I need to start an LLC to get started? Or, should I start an LLC to get started? And I did not start an LLC when I first got started because of the way that I got started into real estate investing. And I would definitely recommend it, but it's not needed, right? You don't need it to get started. And you can always, create one later or, place a property into an LLC or what have you. I don't believe that it's a reason to, stop someone from getting started. If you have a great deal, capital, Scott touched on as well, is one of the very important parts that you need to do any kind of deal. But I can tell you, the better the deal you have, the easier it will be to find money. If you were to come to me with a property in New York City that was $100,000, but it's worth $1 million, I'll find the money. I don't have it, but I'll find it, right? And I think that same thing kind of applies. The better deal you have, the easier the money will come. So that's definitely a barrier of entry. But I try to explain to people that, there are going to be these barriers, but when you do have a mentor or someone who's been down this path before, they can kind of direct you which way to go.
Great, thank you. Eugene, did you want to contribute anything on that?
Sure. I mean, look, I'd echo kind of Akeem's point in that real estate has a number of moving pieces. On the first deal or the second deal, making sure you've got people around you that can at least advise, or having that team there is extremely important. I'd certainly recommend getting kind of the cast of characters together before doing your first deal, right? Having a title company that knows what they're doing, having an insurance agent that knows what they're doing, having a lawyer you can ask some questions to who know what they're doing. And frankly, I think that we found as a pleasant surprise, and I think that most real estate investors will tell you that when you're starting out, people are generally generous with their time. A lot of people in the real estate business got into it at some point. There's, not everyone in the business has been doing this for a generation. So a lot of times you can get advice, you can get that team together with people just giving you some time and answering some of those basic questions and building. I'd really, really, really encourage building that cast of characters, because whatever you're going to go through on your first deal, the reality is there's a lot of people that are pretty accessible to you that have gone through it a number of times before. And so it can help you navigate those issues that could arise when, if and when they do.
Yes, that's true. One of the barriers that I've been seeing on my side, I've been doing real estate settlements for years. And currently, I think Scott mentioned that it's a seller's market. So one of the barriers right now is actually finding properties, because a lot of people are putting in offers and they don't get it, So I would encourage people to be ready, have your financing in place, have some of your key players, like having a title company, maybe it's an attorney, maybe it's a real estate agent, but just being ready to make an offer before somebody else gets that good deal. It's really creating barriers for people to be able to invest because they just can't get the property at this point. Okay, that was good. So starting anything for the first time can also lead to mistakes. And so some of the common mistakes and pitfalls investors who have done this for a while have seen along the way. So from our panel, I'd like to start maybe with Akeem. If you'd like to share any of the pitfalls that you've seen or made along the way.
Yeah, so I would say that one of the biggest pitfalls that I see for people when they're getting started is not truly understanding the budget and all of the numbers that go into a deal or trying to make a deal work. It's not, it's a lot of times we break it down like, oh, purchase and rehab. And it's like, no, there are utilities, there are taxes, there are so many other things that are gonna, just chip away one by one. Any one may not be, a large number by itself, but they start to add up. So just not having a full grasp of the budget and the possible things that could come up is one of the biggest pitfalls, because if it doesn't make dollars, it doesn't make sense, right? So, we're not investing and doing this just for fun, right? It may be fun, but it's not just for fun. It's really to make money, better the community, things of that nature. And so it needs to be profitable. And so I would say that's one of the biggest ones. The other one I see a lot of times with investors is just analysis paralysis. They've read 3-4 different books. They all say the same thing. They know, they attend these kind of things. They know the answers. Someone in here right now may already know everything that I'm saying, but, they just haven't taken that step. And so I think that one's really big, just analysis paralysis, and then just, knowing your numbers.
Great, thank you. Scott, would you like to contribute to any pitfalls that you've seen or made?
Sure. I think especially managing kind of a fund there, I think the number one pitfall that investors that I've seen make is just not thinking about the downside, only worrying about the upside. And I think what goes hand in hand with that is really understanding who you are as an investor. What is your risk tolerance? What is your risk tolerance for leverage? What is your risk tolerance for your budget? What are you comfortable with in terms of putting money into a potentially illiquid investment? So I think those are two things that are really important, is considering the downside, as well as just knowing who you are and what you're going to be comfortable with given your situation. What's your risk tolerance?
Yeah, that's good. I was thinking about when you were saying that in negotiations, sometimes people don't have their walk away point. they get wrapped up in that negotiation and they really want the property, they get sold on it, and then they've gotten to a point where there's no profit there anymore, but they were just so wrapped up in it that they didn't establish the walk-away point at the beginning, and then they're still going. Eugene, would you like to mention any pitfalls?
So the cost piece, so here's an interesting data point for you. So we don't do a lot of fix and flip lending anymore, but between 2016 and 2018, we did about 60 fix and flip loans. And out of those 60 loans, about 40 to 60 people didn't make any money, right? And so I want to echo Akeem's point, which is real estate, especially the fix and flip world, it takes longer and it costs more than you expect. And there's surprises. And especially in the beginning, you're going to learn by doing. That's how most people learn. That's how I learn. So don't go into anything that isn't obviously going to be profitable, because it may be obviously profitable day one, but by the time it's over, it'll become maybe a little bit profitable. But if you go in up front with like, it all has to go perfect for me to make any money, at least 2/3 of the time, you'll be very disappointed. So I would just echo, it's not worth working for free. If it's not worth picking up a hobby.
That's great. So we've come to our last question that we've had in advance, and I'm going to, again, direct this to everyone on our panel. And I know everyone's going to have a different opinion on this. So how much should your down payment be versus how much you should finance? And that's assuming you'll have monthly income on the property. So first I'll ask Akeem, what do you think? Should you put down as much as you can leverage the bank and not put in a lot of cash?
And so based on the question, it sounds like it's a rental property.
Right.
And so I am a fan of leverage. It's one of the great wonders of the world that will allow you to, when used responsibly, to just maximize your earning potential. So I'm not a fan of putting down like the most that you can put down. I'd rather put between, and it really depends, because what you would do for a rental property versus what you would do for, a fix and flip is going to be different. But based on this question, it sounds like it's a rental property. And so I would only put down what I'm required to put down. And I would keep or make sure I have the other money in case something goes wrong. So I still want to have that money, but I'm not going to necessarily put it down. If the numbers make sense with the minimum amount down and I'm profitable and, I've run all my numbers and it makes sense like that, I would prefer to do that. For the reason that, one, it's already profitable. Two, I like leverage. And then the other reason is because, if you put, let's say, most of your money down into this one property, that's still very risky, right? Because if that one property doesn't go well, then, you're kind of screwed. I would much rather spread that same amount of money out to 2 or 3 properties. And now I don't need, all of them to go perfect in order for me to make money. So that's my personal answer. And, again, that's for a rental based on the question.
So Scott, would you agree with Akeem, or do you feel different that you should put more cash down and borrow less?
Well, I think Akeem made some really, really good points there. So I'd agree with a lot of what he said. My area of investing in real estate isn't necessarily like a single rental. So, but I think some of the points Akeem brought up, I think translate across a lot of different properties. So leverage being used, like the keyword here is responsibly. It's something that we've seen historically is investors who were over levered. That's when people tend to lose money or lose properties if something goes wrong, is if you're over levered. So I think it goes back to my answer before, is also knowing your risk tolerance. Like, what are you comfortable with in terms of a down payment? If it's going to keep you up at night every single night because you put the minimum down, that might not be the right decision for you. We have certain apartment buildings that we've purchased where we've leveraged, we've got with 50%, basically 50-50 equity debt. That's the risk tolerance of the market that we thought was appropriate at the time. So it really depends on also the type of asset. But the other thing that I think Akeem said that I think is really important as well is the more money you put down, that could potentially limit your ability to diversify. At our company in particular, we're huge proponents of the concept of diversification. And even if it is the perfect deal or it seems like the perfect deal, it's real estate investing. I mean, especially if you natural disasters, things that are totally unforeseen can happen. So the concept of diversification can be really, really important. And of course, the more money you put into one deal means the less that you could potentially use to diversify across additional assets.
So Eugene, so do you think, or can you talk a little bit about like the different requirements for each type of investment property? So would your opinion of leveraging be different on a rental versus of a single family home versus the multi-property apartments that you have?
Sure. So look, we think of leverage. Internally we have these conversations a lot, and we think of leverage almost as a function of what's this asset going to be worth, as opposed to what are we going to spend on it. We've taken the position internally that we want to make sure we can survive kind of some stress in the system, right? So like in 2008, housing prices in the Baltimore Metro went down 25%, 30%, in the DC Metro 20%. So if I was going to be in the single family housing business right now, we'd be thinking to ourselves, I want to survive a shock. I want to make sure that if that kind of drop happens again, I don't have to put more money in out of my pocket, right? But that being said, we're thinking to ourselves, what is it worth when it's done? Not how much does it cost? So if we have a great deal, right, to Akeem's point, if I'm buying something in Manhattan for $100,000 and it's worth $1 million, which I've never done, if anybody finds one of those and needs a capital partner, call me. But if I was, I'd go take 100% leverage. There's no reason not to, right? Like I feel really good. It's worth $1 million. There's a market shock. It's worth 800,000, 700,000, 600,000. I feel really good about paying back that $100,000 of leverage. Right. So if today, if we have a project we're working on, mainly storage, a little bit of multi, and we think there's a lot of value creation, how much it's worth is a lot more than what it costs. We'll be more aggressive on how much leverage we take. More aggressive is, if it's really a home run, we'll go to 85%. And if it's more of a up the fairway regular deal, we'll take 65% leverage, because same idea, there's not as much value there to withstand a shock. And the last thing we want from a risk tolerance standpoint is if there is a shock to the system, but it reverberates, there's problems everywhere. We don't want to have to find ourselves one day waking up and needing to stroke checks into every single project that we own. That's a risk tolerance question, right? Some people, frankly, are fine with it, especially if you're 25 in a different place in your life, right? Versus if you're 55 and you're about to retire, you maybe want to take that risk a little more aggressively.
Right, that's true. I was also thinking that, like currently, the interest rates have been so low, so money has been cheap. So how I would have answered the question is kind of different when rates are higher than when rates are lower. So right now, I would say borrow as much as they're willing to give you, because if you can get 3% or anywhere in that range now, it's better to keep your money than to use it on a project like that. That's just my opinion. And again, it changes also. If this were someone investing for the first time, in their home, and maybe they're going to be able to rent out part of it as Airbnb, you may want to put a little more money down so that you can always cover the payments, that you are able to always make those monthly payments. So again, it goes back to that risk tolerance that you were saying as well. Okay, so I think we're going to introduce Ryan now, because Ryan is going to have some other questions and answers portion that I guess people are sending in as we are talking.
Awesome. Thank you, Terry. Many thanks to Terry, Akeem, Eugene, and Scott for their insights, knowledge, and tips on the beginning, the real estate investing journey. We will now open up for questions or comments from the audience. We will start with the questions that have been submitted via the chat window. Afterwards, if you have a question, we will open up for those. You can always add your question to the chat as we go. First question that was submitted: why should someone diversify their investing to include real estate investing? This is from Caitlin in the class of 2014. Is there anyone that would like to go first and jump in and answer this question from Caitlin? How about
I'd be
Eugene?
happy.
Go ahead, Scott, it's all you. Because actually
Sure.
you're on a great platform to do just this.
Well, real estate, when it comes to diversification, if you think about traditional assets, stocks, bonds, publicly traded assets, real estate being a hard asset, a real asset has intrinsic value. I think if you've been watching the news at all, you've been probably hearing a lot about like inflation. It's like, well, that's one of the benefits of a hard asset, a real asset. It has intrinsic value, which tends to go up as inflation rises. So I think the concept of diversification, just generally, you don't want things that all move in the same direction at the same time. Well, if you own an apartment building, however many units it is, well, if the stock market falls off a cliff, that apartment building probably doesn't change in value the next day. There's a lot more that goes into that valuation of an apartment building. So I think you don't want things that move in the same direction at the same time. And real estate historically has tended to be a pretty good diversifier from things like stocks and bonds. It's a very high level answer.
Thank you, Scott. Eugene or Akeem, anything you'd like to add? Akeem?
Yes, and everything Scott said, I'm in complete agreement with. And the other thing I would say, just again at a very high level, is that for as long as there are people, they're going to need somewhere to stay. They're going to need somewhere to live. And last I checked, they're still making people. So it's one of those kind of fields like healthcare, right? As long as there are people, there are always going to be people that are getting sick, right? So it's a very safe field from that perspective. Now it goes up and it goes down, real estate does. But if you just hold on, whereas if you compare it to some other assets or asset classes, they may not have the same intrinsic value of, well, even if this wasn't worth anything, I can still live here, right? It provides additional value when compared to other asset classes. So I think it's just one of the ones that you would want to keep in your portfolio or add to your portfolio, regardless.
Thank you, Akeem. Mr. Perverni, would you like to add anything?
Sure. Look, real estate represents a fourth of the U.S. economy. It's from where do you invest your money? It's not about. It's a reasonable place to diversify some of what you have. I will say, I actually think the real estate is, in some ways, it gets too good of PR sometimes, as kind of the saving grace of what you do with your money. The reality is, look, it's a good business. Obviously it's a big part of the world that we live in. But it's not for everyone's not the right way to put it. It's not a magic kind of pill by any means. It's a hard business. You've got to grind. You have a lot to do. Yes, you can get lucky, right? But I think if especially for passive investors, if I was a wealth manager, I would tell you it should be part of a well-balanced portfolio, right? Because the reality is you could have bought the S&P 500 in 2010. If you levered it like real estate, about 3-to-1, you'd made a 12x return over the last 10 years. If you bought the S&P 500 in 2016 and levered it like you lever real estate 3-to-1, you would have made a 4x return in the last 5 years. What makes real estate kind of an easier barrier to entry market is that it's easier to get leverage. But if you really look at it on a levered basis, it performs in a lot of ways similar to other sectors of the economy. So I wouldn't look at it as a silver bullet if I'm a passive investor, and more of a proper portion and diversification. Don't mind my 4-year-old child crying in the background. It's the beauty of Zoom.
Thanks, Eugene. All right, moving to our second question. I've been involved in the residential real estate for many years, i.e. townhomes, condos, etc. I am interested in investing in multi-unit residential buildings. Please share some of the challenges that are unique to purchasing and managing multi-unit buildings. Raj, MBA 2007. So I'm going to first go to Mr. Perverni, as I know you've had some experience in the multi-space and multi-unit space, and then I'll let Scott and Akeem chime in as well.
Sure. Look, the big delta between single family and multi that you notice quickly is we don't do a lot of single family rental, but we've had a couple. You realize you don't get to pass everything on to your tenants. When I've had a couple of rental townhouses, they pay everything, right? They pay the water bill, they mow the lawn. Right. Once you kind of move to the multi-space, you find out you're responsible for the utilities in the hallways. You've got to remove the snow. Some of that operations is different. It's a competitive space, right? I think going from single family rental to multi-family rental is not a very kind of not a big jump as far as process. You're more or less dealing with people. You're more or less doing the same thing. But whenever you're in any kind of rental product with people on the other side, I'll highlight what I said before, which is it comes with a certain level of brain damage, right? If at 2 a.m. something's broken, you're going to get a phone call. Make sure you want to take that phone call or have somebody that will. And the more tenants you have, the more brain damage you get. So at some point you end up trying to outsource it. But it's achievable. It's doable. I think Terry had mentioned earlier that, right now it's a competitive landscape, right? It's hard to find a good project. That's generally the case. I wouldn't say that should discourage people. I think it just means you have to look and kind of keep looking and be ready to strike an opportunity when it's there. And, some people always say, look, wait till the market dips, but you never know, right? You never know if the market's going to go up or down, if there's another 5 years of it being a seller's market, another 5 months. So, I think there's always opportunity out there. You just have to kind of push forward and be ready to seize it when it comes in front of you.
Thank you. And Terry, please also feel free to chime in on any of these questions as well. So Terry, I don't know if you have anything, Scott, Akeem, as it relates to this question. If not, looks like Terry, you're still.
I would echo a lot of things Eugene said. It's more people. So instead of one tenant, you have 5 upwards. We just bought an apartment building. It's 300 plus units. It's 300, not people. It's 300 units. So just when you start to add more and more things, the complexity and the number of things that can go on just increases. So definitely something. There's whole companies, property management companies. It's what they do for a living. So as Eugene mentioned, at some point maybe it comes outsourcing, but you're just really adding just multiple people and multiple potential problems. But of course, that comes with more potential diversification because you don't have just one tenant, you have multiple. So there's definitely some pros to those cons as well.
Yeah, I was gonna say there is like a fundamental basic of it too, is that when you start investing, it's like a job. So if you have a full-time job where you're not accessible, or sometimes you will have to outsource some of the services and things, like having somebody ready to take calls. And a lot of times I think people think, I'm just gonna invest in it, but I don't really have to give any extra time. It's just, I'm going to put my money in it. It's going to make money for me. But it's a job. It's work. You have to work it and learn from each time that you do it, what not to do the next time, or just some of the basic things. Location. I mean, everybody's like, location, location, location. If you're investing and you want to make it a rental, think about that. The location is, you might have a great deal that comes along, but if it's in a terrible location, you're going to have a hard time renting it. So again, just basics to keep in mind.
All right. Akeem, do you have anything you want to add or move on to question 3?
Yes. And so as I mentioned earlier, I don't currently have any multi-unit properties. I'm in the process right now of fixing up a property I recently purchased. I'm converting it into a multi-unit. But I do have other rentals. And so what I'm expecting, or what I'm going into this expecting, is that, for anyone who's ever lived in an apartment, basically all of the things you hated about living in an apartment, that's, going to be your tenants now, essentially living in, depending on how it's set up, but living in an apartment, right? It's maybe a single family house, but if it's split into 2 units, someone's over top of someone else, or right next to someone else, and they're sharing a wall. So these are the kind of issues that you're going to have to deal with now, right? So you're not living there, but you're still going to have to deal with them because your tenants are going to have to deal with them. So that's one of the things that I'm kind of expecting and going into this, thinking about in advance. But as Terry mentioned, and I believe in, I look at this as, it's essentially a job, and I love to pay people to solve my problems. Right. And so essentially when you're doing that, you're becoming a CEO, right? So if you go and buy a multi-unit property and, if you hire a property manager, you may not be dealing with the calls about the toilet or the leaky faucet, but now you have to manage the property manager, right? So now what you're doing just shifts. And so those are the kind of things that you need to think about and just make sure that, that's in alignment with, what you want to get out of this investment.
Thank you, Akeem. Next question. What recommendations can you provide for finding a reputable company to assist in determining the cost of the work to be performed and then managing / performing the renovation. This is from Linda Allen. Anyone, if you want to jump in, just unmute yourself or raise your hand and unmute yourself. Hakeem?
Yes, so not to be discouraging, but for me, finding a contractor, a reliable contractor that stays on budget, stays on time, does the work right, is one of the hardest parts. So the positive is, if you can figure that out, if you can find that person, then, you have a good future ahead of you, basically, right? But it is one of the harder parts. And, so I would just say referrals, working with someone who's kind of already been down that path before, someone that has used that person before. And, that's just a place where you start. It's not going to always be perfect because you're, if you're going based on someone else's referral, but they are okay with maybe a lower quality of work, for example, then, and they're saying, hey, this contractor was great for me. They're, what they were expecting and what they were looking for is going to be different than what you were expecting and what you were looking for. But I just believe that referrals are probably like the best place to start. This person has worked with this person before, it went well. Okay, now we can talk, right? So that's what I would say. Just making sure that you are aligning yourself, networking with, with people in the industry, people that have been down this path before. And, this is something that just from business school, I remember just networking, right? You never know who's going to, might help you or be important to you. So just treat everyone with kindness, save people's numbers, stay in touch as much as possible, and then put out there what you're looking for. And, the universe will bring it to you.
Thank you, Hakeem. I think the leveraging of the network is a key takeaway from what you said. I think that's tremendous advice. Terry, Scott, Eugene, anything you'd like to add? Terry?
Yeah, I was just going to mention, I think I mentioned earlier about HGTV. And if you watch those shows, they make it look really inexpensive and really easy. And I don't think they factor in labor costs at all when they're giving those estimates of contractors and things like that. So they'll walk in and they'll say, oh, this kitchen, we can redo it for $15,000. And in reality, it really can't be unless you are also, a professional and you're able to do this remodeling and do this stuff yourself. Just know that it's a lot more than what they make it out to be. I see a lot of people that, they'll invest in a property and they plan on, they're just going to fix it up for, they have a budget of $40,000 and then it ends up being $80,000. It's not what they thought. They aren't making a profit in it because the low bid is not necessarily the bid you really need to take. You really need to make sure that you are working with someone, and it comes with time, and showing up is really important. Having someone reliable, because every day is money. Every day that you're not getting something done that you contracted to get done, and things are contingent on each other. Plumber doesn't show up, so the electrician can't do what he has to do, and things like that. So it's really important that you do start, getting, again, all the players in line when you're going to start investing, if you're going to be rehabbing anything.
Thank you, Terry. Scott, Eugene, anything before I move on to the next question? Okay. Next question. What are the panelists' thoughts on BRRR, buy, rehab, rent, refinance, repeat strategy? This is from Kavan. Eugene, looks like you're a fan.
Look, if it can be done, it's great, right? Like it's a good way to build an asset base, right? If you can buy the asset, rehab the asset, put some value in, refinance, get all your money back out, and have your tenants there carrying the debt. It's a good way to build an asset base, right? And look, once in a while you think to yourself, after you do 5 or 10 or however many you're looking at doing, do I sell a couple of these for the liquidity event? The problem is sometimes you don't create as much value as you think, so you can't get all your money back out from refinancing. But we're certainly fans of it, but especially if you want to be in the real estate business long term, one of the biggest barriers we see is balance sheet, right? You want banks to lend you money, and banks want to see that you already have money, right? So the kind of good old chicken and egg problem. And one way to build balance sheet is not to sell what you're working on, but to keep it on your balance sheet. And right, and that way it's there, and there's presumably some equity between the equity and the debt, and that's getting paid down over time, and hopefully the value's going up over time. So you're able to build a little balance sheet for yourself so that you can, it makes it a little easier to borrow money from banks going forward. I mean, we're fans.
Terry? And
If
then I'll go to Akeem.
you are going to do the BRRR, I encourage you to really look into 1031 exchange. Because if you're going to keep doing that, you should, if you have money to reinvest, then, avoid taxes. Because a lot of times the taxes, you lose a lot in the taxes when you're doing that.
Thank you, Terry. Akeem, looks like you had something to add.
Yes. So I love the BRRRR strategy. I recently just did one. I'm actually slowly starting to make that one of the main components of my strategy for a lot of the reasons that Eugene mentioned, because you want to have these properties on your balance sheet because you benefit from appreciation, right? If I own a property that's $100,000 and it, the market moves 10% and the market has moved more than that over the last year, right? That's $10,000 that I didn't do anything for, right? And so the more properties you have like that, the more money you're making all at once. So I love the BRRRR strategy because you get to keep the property. Your tenants are paying it off, ideally, right? If this all goes well. I don't think it's I don't think it's necessarily the easiest strategy to implement or start with. But it is something that, if you get started, definitely take a look at it because it can help you in a number of ways if it goes well.
Thank you, Akeem. Scott?
Yeah, but I would say we do a derivation of that with a lot of our apartment complex investing. So, buying an apartment that maybe is a little bit older, doing some renovations, renting it out to people, looking to capture the appreciation, then selling over time. I think one of the benefits of that type of strategy that we've seen is that you get the opportunity to not only potentially capture appreciation from the market, but you're also at the same time collecting rental payments. So it's an interesting way to not necessarily just focus on one way of making money in real estate. You have the opportunity to potentially make both depending on your time horizon. So for us, it's looking for 7 to 10 year time horizon. So you're hoping for appreciation while you're getting regular payments from like rentals, for example, while you're doing these renovations and hopefully raising rents over time.
Thanks, Scott. Akeem, you want to add something real quick?
Yes, and as Eugene mentioned before about having the properties on your balance sheet, I just wanted to give a quick example. I have a property, or really two properties, that I purchased in 2017. And recently, Baltimore City has decided to do a lot of work in that area. So homes in that area are, appreciating like crazy. And I've been renting it out all along. But now I have a lot of equity built up in these properties because I owe a very, very, very low amount. I think maybe like $18,000 on each. And so I was able to recently buy another property without bringing any money to the table by doing like a cross collateralization. And so that's something that someone else, you guys can look up later. But basically, a lender came along and they said, hey, we see that you have equity in this property, you have equity in this property. We're going to put a lien on these properties, and we'll give you all of the money to buy this other property and fix it up, right? And so that's the one that I'm turning into a multi-unit. And so, you definitely have to be careful with it. You have to know your numbers. You have to know what you're doing. It's not for someone to start off with, but that's just one of the benefits of going the BRRRR strategy and going the BRRRR route, is that you can end up just not even needing your own money to purchase properties and fix them up.
Thanks, Akeem. We're going to close with one more question before wrapping. If you submitted a question and it wasn't answered, we will be sharing them with the panelists, and we will get you, their thoughts on your question. So the last question for the panelists: what do the panelists think about using a commercial loan instead of a standard mortgage loan to be able to put less money down on a rental property? How to manage the higher interest rate and possible balloon payment that comes with commercial loans? This is from Nathan Mills. Eugene.
Sure. Don't do it until you have to. Don't take a commercial loan until you cannot take any more residential loans, meaning those residential loans are subsidized by the US government. There's nobody in their right mind that would lend 80% of value on a house to good old Ryan Miller, fresh out of college, right, at 2.9%. That doesn't exist. That only exists because that market is subsidized by the government, and that provides homeowners and investors in the beginning in the 1 to 4 space until you have maybe like 4 or 5 of these. I don't know what the number is, but it's more than a couple in your name. Like, it's an unbelievable financing tool, right? You get 30-year fixed money. It's really cheap. There's no balloon, and you can prepay anytime with no penalty. Once you go in the commercial world, it's a whole different game, right? It's short-term money, the rate is higher, and you have to there's penalties to prepay, right? Because there's someone on the other side of that trade that isn't subsidized by the government that says, look, you want me to lend you money at 5%? I will, but I don't want, if interest rates go down, you refinancing me and lowering your rate. If you do that, you're going to pay me a prepayment. I really don't recommend doing it until you absolutely have to. There's third-party legal that gets involved, right? On the residential world, you're just signing documents. You're not even engaging a lawyer. They're form documents, and they're very fair documents, right? In the commercial world, there's lawyers involved on their side, on your side. The documents are not nearly as friendly. There's ongoing compliance involved, right? In the residential world, if you have a 3-unit apartment building and that building is vacant because all the tenants moved out, as long as you keep paying the mortgage, nobody says anything to you. In the commercial world, that building goes vacant. Doesn't matter if you pay the mortgage. Your bank's calling you that, you know, you're not meeting your coverage ratios. You're not meeting your legal covenants. It's a different ballgame. My biggest piece of advice is avoid it until you absolutely can't avoid it any longer.
Thanks, Eugene. Anyone else that wants to add? Hakeem, and then
Yeah.
Terry.
So I'm not an expert when it comes to commercial, but I do know a lot about it. And what I would say is basically everything that Eugene said, I agree with. So that's why I have not went that route yet. I'm still able to take advantage of residential loans and creative financing, things like that. So that's what I'm doing. I'm avoiding commercial for as long as possible for those reasons. I think in the question they asked about going commercial because maybe putting down a lower down payment. But as far as I know, when it comes to commercial, more than likely it's going to be a higher down payment. So, if that was one of the reasons, that's enough for you to turn around right away. You're going to be looking at a higher down payment when it comes to commercial from everything that I've seen. And I just think that as long as you're dealing with a property that's 4 units or lower, it's considered residential. You can qualify for these residential loans that are again, maybe 4%, 3%, whatever you can get kind of based on a number of factors. But I mean, over a 30-year time period, that's just ridiculous, right? And so, it's subsidized, like Eugene said. And so why not take as much advantage of that as you can before, making it harder on yourself?
Thanks, Hakeem. Terry?
Yeah, I was going to agree with both of them. And also keep in mind with commercial loans, they usually make you personally guarantee it as well. So you're not gaining any kind of, legal stance by doing a commercial loan, because most of the time, if it's an LLC or you incorporate or whatever, everybody's going to have to sign personally guaranteeing that loan as well. So just something to keep in mind.
Scott, anything you'd like to add before we wrap? Awesome. Well, thank you again to all the panelists for sharing such great information on real estate investing. This will conclude the webinar. Thank you all for joining us. A link to tonight's webinar will be shared and posted to the Alumni Relations website once it's finalized. I hope everyone enjoys the rest of their evening, and thanks again, everyone.